Hey guys and girls, thanks a lot for tuning in and checking out this special sort of broadcast. We're trying to do a Facebook Live, however, we weren't able to just for technical difficulties with Facebook. They don't allow screen sharing. But today I've got a special guest on, Mike Donaldson. Hey Mike.
Hey guys, how are we?
Thanks for joining us today, Mike. I think for everybody out there, like a lot of people may not have seen our last webinar that we did. But for those of you that are not familiar with Mike, I'll get Mike to introduce himself in a moment and give a bit of a background on what he does and how he helps people. But in short, we did a webinar recently, which went on for maybe 2 hours, 3 hours, and everybody loved it. And lots of people realized things that weren't possible beforehand. We were talking about super funds and, how to protect yourself and, obviously naturally things that are happening out there. And I wanted to get Mike on today to talk to the bigger masses. So, maybe be able to share the love and help people escape the current position we're in. So just before I hand it over to Mike, some of the things that we're facing, as we can see on my screen here at the moment, rising fertilizer and energy prices could hit Aussie supermarkets hard. Inflation is running rampant. We talked about hyperinflation a couple of years ago. People said we're stupid for talking about hyperinflation. It would never happen. How's this possible? Whatever. But now we're seeing prices of everything rising up. Doesn't matter if it's food, doesn't matter if it's shipping, doesn't mean if it's, any commodity. We're seeing, I've got this next, the next slide here with next article, which is World Energy Crisis offers Australia 349 billion opportunity. Soaring prices of gas and coal look set to drive Australian resource exports up to 349 billion as big economies such as China, Europe battle energy supply crisis. Just recently, we've seen India, Lebanon, China, US, and the UK. They're the articles that I've seen with power outages. There's not enough coal. They can't get coal. Apparently, Corona stopped coal. Well, here we are with coal prices that have quadrupled. I think it might have even gone up higher since I've last looked at the chart. They've gone up so high that the power stations around the world have a decision whether they're going to keep the power plant running. And if they keep the power plant running, they will go bankrupt for paying the high coal prices, or they pass the coal prices on to the consumer, which will bankrupt the consumer, or they try and minimize their expenditure of resources that they're using. And it's simply that there's massive inflation happening everywhere. If we've seen, China making a product out of raw materials, using coal, using natural resources for their energy, that's putting a massive pressure on costs. We've got shipping that's gone up massively. We've got here news articles every day. China's Evergrenade. I know it's not Evergrenade, but it looks like Evergrenade because it's a time bomb ready to blow up and blow our fingers off. The Chinese economy's imploding. Every news article see it's a Lehman's moment, it's this, it's that, the next thing. I think there's been about 4 or 5 of these property funds which have imploded over the course of the last 2 months. I think it's amazing because it leaves great opportunity. Seeing all these stimulus packages out there, which obviously cause these bubbles. So they've got to find the next thing that they can try and inflate, which is, most likely green energy and other sort of things. We've got paywalls, which we don't want to go into, but that one just says here, the heading of it says, ignoring climate will cost 25% of global GDP. So here we go into the next Ponzi that they're going to create. We've got China selling $4 billion bonds as Evergrenade woes fester. Just remembering like 10 years ago, $4 billion seemed like a lot of money to us all, but now, a lot of money, $4 billion doesn't seem like a lot of money. We go on to the next article, which we can't see here, which we've got another paywall. Oh, we can get through that. Supply chain chaos is already hitting global growth, and it's about to get worse. 100% it is. I told everyone there's a few things you need. You need food, you need shelter, you need energy, you need community, you need barterability, you need ways to be able to trade and move through a collapsing financial system, which is what we're seeing on all different fronts that have been occurring. And finally, a last little article to look at is the Australian Central Bank faces pressure to follow the Fed with a framework review. And it's amazing, right? We see all these articles and they, touch on the surface and they're kind of giving us a bit of an idea of what's about to happen. And we start seeing things happen. It's funny, we see here Phoenix Children's mistakenly IDs, right? We're going to have digital identities. We've got review of monetary policy. We've got all of these things happening which have come out in light over the course of the last 12, 18, 24 months. It's a very exciting time to be alive, lots of opportunities, and a lot of people are actually scared of what's happening. So, with it, I'm going to leave it over to Mike as we go back to get off the screen here and back over to just myself and Mike. So, Mike, if you could just give us a bit of a background on, is this?
And I'm back. I'm back.
It's out?
Yep. Thanks, Nathan.
Sorry, Mike, I'll just redo that so we can cut out. So, Mike, just on all these notes of news articles and whatnot, lots of things happening out there. Mike, if you can give everyone a little bit of a background just on who you are and what you do. Thanks.
Sure. No, thanks, Nathan. And it's been interesting over the last 3 or 4 months what I've seen. So my background is I've been involved in financial services and particularly financial planning for the last 30 years and have sort of taken my own journey down the property path because of the inconsistency of our regulatory framework, not being too critical. I have to work within it, but at the end of the day, I chose not to give investment advice because I found that the fundamental framework that's set up is designed to force people to use investments that they may not ordinarily choose to be involved in, including directly in the share market, directly into managed funds and other types of investments that really and it focused on superannuation, of course. So we saw changes a number of years ago that allowed people to have freedom of choice. And as a result, people may not know this, but from an advice point of view, if you're dealing with a financial advisor and they're restricted in some ways, they can't give you advice on direct property because it's not what's called a regulated product. So as a result, the only way they get paid and generate revenue is having your money in a portfolio that they can control. And at the end of the day, I'm not saying that what they do is there's anything wrong with it. But when it comes down to someone fundamentally saying, I understand property and I want to be in property, and your advisor says, well, I can't advise you in property, well, then you probably need to talk to another advisor. And that's really where we come in. Our business is a financial risk management business. We don't give investment advice. We don't care where you invest your money, quite frankly. What we care about is making sure you do it properly, you do it compliantly, and you do it in such a way that that you get the best outcome and you're comfortable with what you're doing. We also want to make sure that you put in all of the services and products and frameworks that allow you to mitigate your risk. So our mantra is take the least amount of risks for the greatest level of profit. And what I've found and experienced personally, very simply, is I understand property, I buy property, and I've been a strong advocate, as you have, Nathan, as well. And the facts speak for themselves. So our background is ensuring people don't go up blind alleys, they don't make the mistakes, and we talk to them how they can leverage and get control of their superannuation. And that's what I did 20 years ago. I don't like the idea that, and this is what I've found in dealing with a lot of your clients recently, is they don't truly understand that it is their superannuation. They can control it. They can make decisions on the investments. Even though you may be sitting in a retail or industry superannuation fund, you have options. The problem is that the superannuation funds themselves don't give advice. So if you're thinking, oh, look, maybe the market's not working in my favour, or I'm sick of getting statements that show the volatility of your super fund going up and down, What can I do? Well, they're not going to tell you because they're not allowed to give you advice. Whereas I can give you advice, I just won't tell you what to invest in particularly, but I will show you the benefits of the difference between using direct property. So, like I said, our business is based on a fundamental belief that I'm not going to tell you where to invest the money. I'm going to show you how to do it compliantly. I'm going to show you how to do it with least amount of risk. And then at the end of the day, it's your money, it's your decision.
Yeah. And I think there's a lot of, when it comes to financial planning, always say I don't like, financial advisors will try and see these sort of products and whatnot. And it's very rare to get the right advice. When you're working specifically with a super fund, there's so much red tape, regulations, whatnot. And I quite often hear financial planners that say, oh, don't buy property or whatever, because when they do that, when their client does that, what happens is they lose their 1% annual trail as a commission on the super fund or whatever. And that's why I think it's important for everyone to be their own personal financial advisor. It's called a self-managed super fund for a reason. And, take away all the red tape. Like when you look at accounting and legals, there's always, lots of red tape around legal matters or, conveyancing matters or whatever. And you get a lawyer. When you get an accountant look after all the red tape and compliance around your personal tax, it's important to get someone that's going to be able to look over the compliance of setting up such a super fund or whatnot. And that's why we work very well together, because I think in the last month, you've had like 30 or 40 people that have just gone, look, I'm sick and tired of the volatility. I'm sick and tired of, my money, being not even knowing where the money is. I ask people 3 questions generally about where the super fund is. And I might see that they've got 100, 200, 300, 400, 500 grand in the super, and people don't even realize. And I ask them, how much do you have in the super? And they go, I don't know. And I go, okay, well, who's your super fund with? And they go, oh, I don't know. I think it's this fund. And I always ask the final question, which is, well, there's 2 more, which is, who do you deal with at your super fund? Who do you speak to there that looks after the investments? They go, I don't know. It's just that fund. And the last one is like, what is your money invested into? And if you can't answer those 4 questions, well, then there's something seriously wrong. Because if someone was down at the pub and they were outside and some drunk person came around and said, hey, can I borrow $250,000 of your dollars? They'd be like, get out of here, right? But at least if you needed your $250,000 back, you'd have a greater chance of finding that person. Literally, people have 50 grand, 100 grand, $250,000, whatever, in their super fund, which they can naturally do more things with and don't even realize. And their money's tied up with these institutions that they don't know, who they are. They're faceless entities that are in politics.
And I think one of the highlights of all of that, and one of the reasons I started down the self-managed super fund journey so many years ago, is that the value of my super fund got to a point where it was worthwhile worrying about. There's a lot of people, and again, people may not realise, but the greatest volume of superannuation monies is held in self-managed super fund.
Yeah.
It's not the greatest volume of members, because we're talking retail, and you look at Australian Super, that's got about 11,000 members. Those 11,000, there's probably 70% of those that have got fund balances less than $50,000.
Yeah.
So there's a point where people start out working where they don't really take an interest. The problem is they never gain an interest in their superannuation. They just, it's something that sits over there. And what they don't realise is that, as you pointed out with those articles that you introduced this session with, those institutions, because they receive so much by way of volume of contributions coming in, billions of dollars a year, they have to invest it.
Yeah.
And therefore they go looking for all of these types of things. And the problem you've then got is that you're then exposed to the vagaries of all of the things that go on in all of the economic markets around the world, including the big one, which is this whole issue of supply chain and everything is a big one. And the pandemic has simply brought forward those issues even quicker. Simply because a lot of the people involved in those supply of the raw materials. I mean, we're looking at what's going on with the OPEC cartel at the moment.
Yeah.
you know, a resource-rich country like ourselves, and we're paying the sort of prices we're paying for fuel.
Yeah.
So they were happy to have low prices when no one could drive and go anywhere. But as soon as we're able to get out and drive, we're seeing petrol prices go through the roof. So that's being manipulated by the world economy. Again, one of the reasons why I'm very pro-property is we look at the unique position that property is in this country. You know, we all want to live in 15% of our land mass.
Yeah.
So as a result, the land that's available in that eastern seaboard corridor predominantly makes it very valuable. We've restricted the release of land through government and other reasons, which means that we just don't build enough property to supply everyone that wants property. We've had a little bit of a breather because of the lack of immigration in the last 18 months.
Yeah.
But when that gets back to our traditional levels, which is, you know, 150 to 250,000, you know, and people out there that are watching this will understand that when they've been to an auction or they've been to a open home or they're out there renting, what you're finding is that, you know, you don't have 2 or 3 people turn up, you have 30 people turn up.
And we haven't even got any migration at the moment. So we've just got cheap, readily available credit. And I've noticed some trends as well, Mike. Like we've got people like fleeing places like Melbourne and some fleeing from Sydney and going to places like Queensland for a better life. And I think about it and like the way for us to get through and avoid the depression that we're in, but we're not feeling at the moment with average persons, and is for us to bring in more income and revenue to the country. We can either breed more people to, you know, pay more taxes and have more tax slaves in our system, but we can't breed 18-year-olds quick enough to get them working and being in that system. So we're going to have net immigration to try and bring through this. So I've got to imagine the pressures we've got in the markets at the moment, and then you add in there that we're opening borders. And if people are fleeing from inside our country to other areas, what's going to happen with other countries, other third world countries like US, UK, Canada, and all those places where people are going to be fleeing to Australia? And I find that quite interesting that when we start seeing massive, you know, immigration issues, what sort of pressures they're going to put in the market too. So, I
truly believe that getting control of your greatest asset, and for a lot of people, apart from their family home, their superannuation balance is without a doubt their greatest asset at this point. To not be concerned about it, not understand the potential. I'll give an example of a couple of clients of yours that I have spoken to recently. One of them was sitting back, not really moving forward until I spoke to them and said, well, you're in a position where you can do something. Why aren't you doing it? And generally the information that he'd been receiving and been looking at himself, he kept seeing these numbers that he felt he wasn't in a position to do anything. So they'll go forward very quickly. They're in their mid-30s, young family, and they'll buy a property, and that property, just based on a very, very simple growth and income for the next 30-odd years, will see them, without doing anything else, have a superannuation balance of probably $2.8 to $3 million. After paying the loan off through contributions and cash flow. And quite frankly, at the moment, the government says that we can only have 3.2 million combined between a husband and wife or partners in their superannuation anyway. Just that one act. And one of the major things I talk to people about is the only thing that we do not have any control over, Nathan, is time. And the biggest problem is that, and I've got the other end of the spectrum, some of your clients who have only got several years to go before they need to retire, and you need to make other decisions as well. And so the whole timing issue is important. Investing in a very stable platform, which is residential property in this country, is the best thing to do it sooner rather than later. So if you're out there thinking, oh, I don't have enough, or I don't have enough contributions or whatever, don't you decide that. You come to me and Nathan, and we'll be able to let you know. We'll do the cash flows. We'll work it out for you, and we'll be able to find something for you that can get started, and you can then let time be your best friend when it comes to growing your assets going forward.
Yeah. I think having control of that asset's very important. But the other thing as well, like I don't think people realise or understand enough of, is that, like, firstly, if you've got a 200 grand in your super or 100 grand in your super or whatever, like we've all seen Wolf of Wall Street, and basically a lot of these sort of products that are out there, Wolf of Wall Street style products, we're seeing gross mismanagement and recklessness that is out there in the marketplace. But if you could hold that cash, like people say, I don't have enough money to buy a property. I don't have the 50 grand deposit. I don't have servicing. I've got clients that come to us that don't have servicing. They say, I can't service for a property. I've got 4 and I'm stuck. Well, if you have X amount of money in your super, the super financing, A, is done totally separate, and B, how many deposits would you have to be able to build the other half of your portfolio? Some people come to us and they're like, I'm stuck, but they don't realise they can build their other half of their portfolio in their super, as well as the fact that if on your strategy, I know that you're very, very conservative with what you do with your planning and your structuring and whatnot, which is what I really, really like on that front. But if you could build a portfolio of another $1 million worth of assets, and that pays itself off over the next 15 years on a conservative front, you've got that asset that's $1 million today, could potentially double into $2 million. It pays itself off. You've got $2 million there. If someone gets to retirement age, they could potentially sell that off and use that profit in retirement to pay out their personal portfolio too.
One of the strategies that we certainly, and basically what our business is about, is trying to educate people to understand how to utilise the tax effective environment that superannuation provides. Most people look at super and they don't truly understand the fact that it is taxed at such a concessional way. They don't understand that they can also put money into super and have it be tax-free. They don't understand that once you reach your preservation age, you can effectively turn and people will have heard this because a number of the industry funds talk about income streams. There's some very interesting ads that have been out there that I think there's one ad where some chap says it looks like you've sucked on a lemon or something, so which I quite find funny. But income streams are very, very important because you turn your superannuation into a pension phase income stream. And once you do that after your preservation age, and for a lot of people listening to this, their preservation age will be different, but for the vast majority, it's usually around age 60, which means you're legally entitled to get your hand on your super money. Once you do that, you can actually draw down a pension tax-free and use those monies to then debt consolidate and reduce your portfolio outside of super. And that's definitely a strategy that we talk to people about and get them to understand. So I'm very big on educating people to think ahead as to why they're doing things. One of the biggest issues I find is that people, even when they go out and start building their portfolio, they're not really thinking in terms of how to best utilise, at what point do they consolidate and potentially pay down debt. And what we do is we really provide a roadmap that will take them out to that retirement point to really understand the things they should be doing today and the good decisions they make today. One of the things that when you reach 55, you can then take 10% of your superannuation value, and that's the value of the fund. It doesn't have to be cash, it's the value of the fund. So let's say you've got $1 million in your superannuation by then, 20 years down the track.
Yeah.
You could take $100,000 of that in what's called a transition to retirement pension, and you could use that money to pay off non-deductible or deductible debt outside of super. And the whole idea is to put yourself in a position where you've got, like you've said previously, you've got income streams which are basically free of any debt. Because again, one of the things we find people don't really think about is that they sort of rush forward to get to that point. And a lot of it's driven by the fact that they're still working.
Yeah.
And then they stop working.
Yeah.
And all of a sudden the cash flow is not there, and all of a sudden it's a bit of a panic stations. So we like to make sure people, from a roadmap and a planning and ongoing education, you need to start to plan for what your retirement streams and your wealth looks like, 5 to 7 years out before you really need it, so you can make some good decisions. So again, that's what the planning process really does for people. We project people out to their retirement so they can go, yeah, okay, that's great. I'm now confident. So the couple I spoke about just a moment ago, it's almost like a weight's been taken off their shoulders, because they go, well, we've just got to do a few things now.
Yeah.
And we set ourselves up for the future. And most people don't have, grandiose plans. They just want to know that they've got enough to continue living the lifestyle and providing for their family into retirement. Because the way things are at the moment, and I just saw some stats recently, Nathan, where we're going to see within the next 5 years, life expectancy for females in this country go over the age of 90.
Yeah, wow.
Over the age of 90. Men typically are 2.5, 3 years behind that. Yeah. There's lots of reasons for that, which I won't go into now. I'm married and I want to stay married. That's a crazy thought when you think that same person could have a preservation age of age 60, legally get their hands on their retirement money, and then have to have it last for 30 years, which is almost as long as they were probably working for.
Yeah.
So it's so important to understand and maximise the strategies to make money work for you. And the big one for me in the SMF, and it's what we've spoken about and we spoke about on our webinar, you can't leverage in a retail or industry fund.
Yeah.
We've got very low interest rates at the moment, so it's a great time to leverage. And more importantly, if you have a property and you keep that property until you retire, then due to the way in which you are taxed in retirement through your super fund, you will pay zero capital gains tax on that property.
Yeah.
Because as soon as you retire and go into pension phase, you pay no tax. Capital gain tax is only 15% at the tax rate on the super fund at 50%. So it's only 7.5% anyway. But if you've got $3 million of asset, of which $2 million of that is a capital gain, 7.5% of that is a big chunk of money.
Yeah.
And if you do it properly and you manage it properly, you won't pay that.
Yeah.
So that's why leveraging property in your super fund works, and it works exceptionally well.
And I guess we've run some modeling, the reference back to that webinar. If you guys are watching this today and you weren't on that webinar, you can reach out to my team. There'll be a link. I think there'll be a link in the box, or you can reach out to my team at admin@B.Invested.com.au to actually get access to that webinar. So just ask for Mike's webinar. But we talked about in there scenarios about if someone had, 300 grand or 200 grand in their super fund and they didn't leverage it, and you got a 5% return if you're lucky over the long term, or if you put that capital into property, you could leverage 200 grand into 500 grand worth of assets. So if you've got the cash flow coming from that asset, you've got the capital growth from the asset, plus you've got a larger asset base that's going to go up in that market cycle. So and the other thing as well, you touched on it in depth beforehand about people not realizing the power of their super fund. We've got the most controlling, the most evil, the bad people out in the world, which control all the wealth and whatnot. They've got a lot of these foundations, right? You've got, specific foundations where, they get donations and whatnot. They're very successful, very powerful entities and businesses that control, and they use those entities for, tax minimization, control, intergenerational wealth and whatnot. And I guess, having the super fund, if you set that up right, you're building yourself, one of those sort of facilities to be able to carry your own wealth and be able to create extra levels of power and control in your own personal life too. So, yeah.
And look, one of the other things we touched on in the webinar, and I won't steal that thunder, it'd be good for people to watch it, but one of the things that's come through really, really strong in speaking, and since the webinar, we've been in contact with over 70 of your clients. And it'd be, people could understand that we're probably have got 20 or more of those already establishing a self-managed super fund for the purpose of buying property. There'll probably be 25 or more property purchases as a result. But the only reason other people from that haven't gone ahead is it's a timing issue for some people as well. Some were inquiring how it worked and really weren't in a position to do anything. But and I'm happy to spend time with people to provide the answers and debug some of the myths and issues that they may have heard. We're also dealing with people who are probably a lot older and have got a different type of retirement planning, which is we do as well, making sure people understand how to best maximise what they currently have as well. So our financial planning covers what I call strategic general advice. We don't go into specific product advice. I mentioned that earlier. So we're very big on risk mitigation, making sure people don't make financial mistakes. The reason I think we're so good at that is that I've already been down there for the last 30 years and really understood where all that comes from. So it's practical, sensible, straightforward advice. They're not 75-page documents that are full of robo-generated crap. Our statements of advice run from somewhere around 13 to 18 pages. I guarantee you I write every word in them, and they're bespoke to the individual who comes to us, because we take your personal circumstances and come back to you with, again, what we think you should do strategically and how you should go about it. But one of the interesting things about what we've seen is people really are not understanding the whole issue of timing. And part of the reason why I got control of my own super so long ago, Nathan, is that if you're sitting as a fund manager of one of the major retail super funds or industry funds, and you've got billions of dollars of funds under advice, and you've got to get that invested, and you've got to meet certain objectives of the various types of funds that are available, from high growth aggressive down to conservative cash funds and everything in between. I mean, a number of the platforms out there like Colonial First Aid, BT Panorama, these types of funds have got 150 different investment options. I mean, how does anyone can make any sense of that? I've got no idea. But from an investment manager point of view, I'm not worried that you're retiring next week. So as a result, I'm going to make a decision on the long-term investment opportunities, and that decision could very well mean that in the short term you're going to lose, and it's going to add more volatility to your fund. And I remember years ago being around the industry in the 1987 share market crash, so that gives you an idea of how old I am. And there was two distinct financial planning businesses that I was involved in managing at the time. And one of them, for no reason, the owner and the runner of that business, a business called Investor Security Group, decided to switch all of his clients' funds to cash about 2 weeks prior to the October crash. Just on a gut feel. Okay. Another business that I was dealing with called Retire Invest decided not to. So that particular guy called Robert Keating was his name, built his whole reputation on being a financial planning guru because of making that move. And he admitted it publicly. It was based on no other fundamental advice than he just felt it was the right thing to do. I don't want to be left in the hands of someone who just feels from a gut point of view that I should make a decision one way or another. That's why I got control, and that's why I think most people should get control of their money and then put it in an environment where they're comfortable. And we have seen, I mean, I looked at Real Estate Institute of Queensland and New South Wales. Queensland across the whole state for the last 15 years has seen an average growth of properties of about 10.5%. We only project forward at 5%.
And we have factored in the cash flow on top. And
then you get the cash flow, So, at the end of the day, fundamentally, I believe in people getting control. I believe in people taking control of their own destiny, and then me working with them to understand the timing of what works for them, not a fund manager in an ivory tower making a decision to invest in Evergrande. And realising that, the fund's going to take a huge hit just at the time that you're going to retire the next day. And that's what happened to the people in the Retire Invest business. There were people that had portfolios put together for their retirement that lost 25, 30, 40% of their available capital a day, a week, a month before they retired, and you do not get that money back.
Yeah. And that's why I always ask people, like, who's their fund manager, like who's managing their funds, because you need to know the mindset behind that person. Like you sit 5 people in front of each other and they all have a different view, a different belief system, different strategies, different outlook on the markets, but no one's, you're talking about the risk, the low risk option. And I remember once I used to smoke cigarettes and I was out and someone asked me to borrow a lighter, and conversation started talking. This guy was a financial planner and he told me that there's no such thing as inflation. Currencies crash in crap countries. To buy Telstra stocks and bonds were the best things to put into someone's financial future. And I was like, they're the worst things you could ever have. And I think I literally nearly got into a punch up because he was so aggressive about it.
And I could almost guarantee that he didn't do financial planning for long.
I think about 6 years or something, he said, because I was kind of laughing. And I had a couple of mates who were like, no, you should listen to this guy about me. And I was talking about what I was seeing out there. And we look at the super funds, these industry super funds that everyone's got their money into. And if you go to the safe cash option, you're given an option like 1, 2, or 3 of low risk, high risk, medium risk, whatever it is. But what are the products that are in there? What are they being sold? People would have thought that Evergrande is, a saved option. When they say your money's into a cash position, is it turned into a bond, some form of a derivative, and then sold off to Evergrande to use as building a new property? I'm sure that when Westfields go to build a new shopping centre, they don't go to Commonwealth Bank and ask for a 95% LVR for the car park out there. They will raise capital via specific derivatives and bonds and whatnot. Yeah.
Absolutely. And you've only got to look at the ads on TV for Cbus as a classic example. We built this. Well, okay, that's great. So you're lending the money to these projects. Now, the majority of them are fine.
Yeah.
But the reality is you're not in control. And that's the thing that struck me. I like people being able to, I often say this to clients when I meet with them, I'll never tell them what to invest their money in. Yeah. What I will do is educate them to make a good decision as to what is the best thing for them to do. And most importantly, I'll also, and what's very big at our planning process is understanding people on how they manage their own personal cash flow. Yeah. There's no point in me opening up a self-managed super fund with $250,000 of it if someone is in a position either through their own business or their own personal circumstances that they need access to cash. That's one of the things that we highlight in particular, that superannuation has certain rules around it, and there's a big carrot, and that's because of the tax advantage. But there's also a really big stick. Self-managed super fund is administered through the tax office, not through ASIC or through the SIS regulations. And as a result, the only stick that the tax office has is to impose penalties and tax. So if you do the wrong thing in your self-managed super fund, and I purposely try to scare the crap out of people because I want people going into this with their eyes wide open, Nathan. I don't want them coming back and saying, you never told us this. I'm going to give it to you warts and all. And if you're not comfortable, it's not for you, then you don't do it. But at the end of the day, the tax office has the opportunity, if you do the wrong thing, which is why getting proper administration, getting good advice from the team over at One Path as to how you set it up and what products you use and so forth is absolutely critical. And then have someone do the administration of your self-managed super fund because you can't afford to be non-compliant. If you're non-compliant, then the tax office can, they don't do it very often, but they can tax the assets of the fund at 50%. Yeah. So, and again, I don't want people falling off their couches and whatever tonight. But the reason why we go to such pains to go through all of the process and the procedures and the management of self-managed super is we don't want any of our clients to be in that situation. Yeah. And we manage it fairly closely with using outsourced professionals, our own advice, our own documents that explain how things work. But super's for super, it's for your retirement or death benefits. That's what it's for. It's called a sole purpose test. And again, we educate people to make sure they understand all of this.
Yeah. Awesome, mate. Awesome. Well, I can see that we've gone on for a long while today, and there's lots of things. When I speak to you, like I could talk to you for hours. The things that I learned today, I actually didn't know about the 55, the 10% at 55 things. I learn it something new every time I speak to you, which is really cool. I think if people want to get in contact with you, Mike, it's probably best that they just reach out and email or contact our team, and we'll book an appointment for you.
Yeah, look, I think the best way to manage it realistically is to book it through the B.Invested team.
Yeah.
And the reason for that is mainly to have that continuity that, one, we know, and we've had a couple of people reach out to us directly, and we always find out where that comes from. But it's a lot easier. People may not know, but your team has access to my diary. I make slots available on a weekly basis, and they just see if there's nothing in there, they can book you in for and I'm happy to do a 30 or 40-minute phone call that's free to all of B.Invested's clients, and happy to look at your circumstances, answer your questions. It's your session with me. You ask all the questions. And at the end of it, if you're happy to proceed to the next step, we'll tell you what that is. And as we found from our webinar in May, we've had probably well over 30 people moving on to establishing a self-managed super fund and getting control of their destiny. And I think that's a great thing.
Awesome, Mike. Awesome. I appreciate your advice. Everybody loves you when they speak to you. They're very confident and whatnot.
That's the first time I've had any feedback.
No, they do. The feedback's always very well received. So I appreciate that, Mike. And if anyone wants to contact and get in contact with Mike, admin@binvested.com.au. I'll get my editor to put the email down the bottom of the screen. So just email over. My team will book in a chat with Mike. And I appreciate, Mike, all your help that you're doing for our community and helping people get to safety, because
it's definitely my pleasure. And look, and one of the things that, as a final comment, is one of the things we're really big on is the risk management, and we're finding one of the real downsides of not taking a real interest in your superannuation is that most people are significantly underinsured, and most people don't have a valid will.
Yeah,
they're two other things that we address and make sure that they really understand that if you're going to go to the trouble of trying to build an empire, let's call it that, and you build it like Evergrande has been building it, then it's going to come crashing down and bite you in the bum. So making sure that you have all of the appropriate financial instruments and protection is very important to go on the journey, because not everyone makes it to the end.
Yeah.
And we want to make sure that no matter what happens, one of our mantras is we're going to make sure you get through to retirement no matter what. And that means if an insurer has to pay you and look after you for the next 20 years, then we want to make sure that you got right enough. Most people we talk to are significantly underinsured, Nathan, and that's the problem. Yeah. And most people don't know how that it can actually, most of it can be funded through your super, even though we're going to get a spectacular result in your super fund. That includes paying for all the insurance you need as well. So it's very important to make sure that we do the full package. We just don't go set that up and then things can go crashing down. There's no point doing that.
You wouldn't drive your car uninsured. You wouldn't have your house uninsured. Why have your life's work uninsured? And if something was to happen, injured, whatever, and there's already enough trauma in someone's life to have that happen, and shit goes wrong in people's lives. Otherwise, you wouldn't see people in bad positions.
Yeah. And your greatest assets are two things: your personal exertion income and your passive income. Yeah. They're the two greatest assets you've got. Now, to get the passive income, you've got to work hard with a lot of personal exertion income to build it. Yeah. So in that period of building and accumulating, that's when things can go wrong. And if you don't, people are astounded when I do the calculations for them and say, over the next 28 years, you're going to earn $6.7 million in income.
Yeah.
And they go, wow. Yeah. So now we put that in perspective. What is your greatest asset?
Your time.
Your ability to generate that revenue.
Yeah.
Now, how you use it now will determine whether you're generating that income passively or you're having to work for it.
Yeah.
We both agree that the sooner you start accumulating the ability to generate passive income, the better. But whatever you do, don't jeopardize getting to the end result by simply not putting the foundation of covering that. Once you've got enough, you don't need any more insurance.
Yeah.
Okay. Yeah. And for most of our clients, we see a 5 to 10 year window where it's important. After that, you don't need it. If your net assets are going to grow every year, and that's the other thing in the industry, I argue with them a lot. Most clients that have retail insurance have indexation on their lump sum cover. Why? If your superannuation grows every year, your net assets grow every year, shouldn't that be by default only covering your risk? Then your net asset means that you're in a better position next year than you were last year. Your insurance should go down. One of the things that I find interesting, if we're just looking at risk management, which is I've highlighted as really what we do, I am at odds with the industry who likes to have insurance cover going up and up and up every year. I don't, and when I explain this to clients, they sort of go, oh, yeah, that doesn't make sense. And again, this is part of that whole thing of not really taking an interest because it's over there, it's in the super fund, it just keeps going up and whatever. But people got to realise that if their cover's going up and their age goes up, they're going to pay more for it.
Yeah.
I'm very big on no indexation on particular lump sum cover. Why? Because if your supers goes up in value, your assets go up in value, then your net position has to be better than it was the year before. So doesn't it make more sense that your insurance should come down because we're only covering the loss between what you should have and what you need? And
I guess that if you're paying down your debt as well, like your principal will be paying down on your debt, so your position would be getting better each year.
Yeah, correct. So I often make this statement to clients. I said, when you meet me for the first time, it should be and will be the most amount of insurance you ever need.
Yeah.
Because if we do our right thing and we help you grow your assets and you're healthy and nothing goes wrong, and we hope that's the case, then surely that means that by default, if you're in a better position as a net financial asset position the next year, then your insurance needs should be less, not more. So why do insurers index? And it's something that the industry has not addressed because they just tell advisors, well, do you want indexation? And the advisor go, if I did indexation and your cover increases and you have a birthday, then your premiums are going to go up twofold and I'll get more trail commission. And people don't like me telling them that, but that's the only valid reason I can see why it's there.
Yeah,
is for the insurers to sell higher sums insured and charge higher premiums. And for a lot of clients, I see, Nathan, as well, some of them don't have the right level of cover. It's all over the shop. So we have a very strict methodology. We only want clients to have insurance when they need it. If they don't need it, don't have it.
Yeah.
Don't have it.
I think it's important to grow your wealth and protect it whilst you're growing it. So,
but once you've got it, I often make the comment, Kerry Packer never had any insurance.
What was that, sorry?
Kerry Packer never had any insurance.
Didn't? Okay.
I know that for a fact.
Okay.
Why? Doesn't need it. When you have the wealth, you don't need it. But you certainly need it to get to where you want to be if something goes wrong in the short term.
Yeah.
I deal with all the statistics. I know what can go wrong. And it is a little bit frightening. But anyway, I suppose the point of all that, Nate, to say that what we do from an advisory point of view is a lot different to everyone else. I've spent the last 20 years developing this methodology on how we go about advising clients. And from my point of view, I think we get very good outcomes for people.
Yeah. And all my investors love the advice that you give, the guidance that you give, the protection you give, and the awakenment of them being able to see what they can do as their potential. So, as I always say to everybody, I don't give financial advice. I just try and teach everyone to be their own financial advisor. I can't give financial advice, but that's where we need to make sure we've got the risk minimization, and we work together with looking after people.
Absolutely.
Yeah.
That's great.
So on that note, Mike, I can see we've been going for ages. You know, sometimes I try and talk for 10 minutes or 15 or 20 minutes and it goes on for hours and whatnot. Let's wrap up today. And if people do want to reach out to you, contact us at admin@binvested.com.au. And also, if you missed out on seeing our private webinar that we did, reach out and just email the team on the email address at admin@binvested.com.au, and they will send you a link to the webinar. It's probably another 3 hours or so of us talking with charts and explanations of what can happen and whatnot. And yeah, I guess when everyone comes to you, they'll be in a really good position to, know what they need to do and all that. And be able to.
And I think by watching that, it will resonate in various ways for people. But more importantly, it'll probably highlight some of the things they may have thought they knew or they don't know. And that's the reason to reach out for me. Like I said, I'm happy to provide, half hour, 40-minute conversation, which tends to go for an hour anyway. But that's free of cost and free of obligation. I want people to feel comfortable to move to the next step, and that's what we'll do. Awesome, Mike. I appreciate that, mate. Thanks for your time today, and thanks for helping everyone in the community. Good luck, and we hope to hear from everyone who's listening to our chat today. Awesome. Thanks, Mike. Thanks, everyone, for watching. Have a great day. Bye now.